In this video, we are going to walk through how to construct a basic balance sheet in financial accounting. We have some business terms to start with. Assets are what is owned. Liabilities are what is owed. Now, the difference between assets and liabilities is called equity for a corporation. Equity is also known as stockholders' equity or shareholders' equity. In a sole proprietorship, equity would be listed as capital or owner's equity. The balance sheet is a financial statement that reflects the accounting equation. Here is an example of a balance sheet. By the way, this balance sheet contains just a few of the accounts that would be on a typical balance sheet. The company name, the statement name, and the date are always at the top of the statement. A balance sheet is always as of one date. It is a snapshot of that day's ending balances. This balance sheet has assets on the left and the liabilities and equity on the right. However, there is no magic to the left and right. That presentation has nothing to do with left and right like with debits and credits. Some balance sheets are all in one column with assets being first, followed by liabilities and then equity. Balance sheets typically have a current asset subtotal, which is the total of the accounts that will turn into cash or be used up within 1 year, or the operating cycle, whichever is longer. Balance sheets typically have a current liabilities subtotal, which is the total of liabilities or debts that have to be paid within 1 year or the operating cycle, whichever is longer. Here we only have one current liability, so a current liabilities subtotal is not needed. That's it. We are done now. This video was created and narrated by Dr. Wendy Tietz and is part of the Accounting Skill Builder video series. See Accounting as Analytics for additional faculty and student resources.